Hmm. Okay, good. We're live. Good morning, everybody. Welcome to the stream. Let's get started with the jobs report. The jobs report came in a little bit higher than expected. We were forecasted, and consensus was 225,000 jobless claims was expected, 225, and it came out 242. So about 10% more jobless claims than expected. Although I'm from just watching these jobless claims come out every time, that's pretty much well within variance. So it's hard to say that's meaning something. I don't think that's affecting the market. And then, but more importantly, this morning, was PPI at 8:30. And the interesting thing about PPI is we had no inflation, zero. That's on core. And then overall, we actually show deflation. That's the first time I've seen any sign of deflation uh, since inflation started for years now. It's amazing how time has flown. Um, I remember getting COVID yesterday. Also, I got COVID yesterday. No, just kidding. No, but like a couple of weeks ago, I think I did get COVID because I got this lingering cough. But I'll tell you what. Number one, when I got COVID the first time, it was I think the most painful virus attack I'd ever experienced. It definitely came from some weird ass motherfucking wet market eel bat combination because that was some fucked up virus that I got hit from. Check this out. If you know, some of you have heard this, but I told you it before. I was in so much pain by day four, I believe it was, maybe five, uh, that I couldn't get um I couldn't close my eyes. I couldn't relax if I laid down because laying down was painful. Like my inner body, like you couldn't see bruises on my skin, but it felt like my entire inner body, like my muscle system and my organs and my bone marrow were bruised seriously. And so if I laid down, I was in too much pain. So at one point I tried to fall asleep sitting down. That was too painful. So I tried to just stand up and I was like holding on this railing. That was too painful because of the gravity. And I was like, man, if I could just be like floating in space. And that's when I realized maybe I could get in a bathtub. So I filled up a bathtub, got in there, and I literally used it as a bed. I floated for the first time. I got relief. I was able to not have any pain. It was gravity. It was all the bruised, like just feeling in your body being under pressure. And I was finally able to sleep that way. And for 2 days there, during the peak worst of it, uh, I had to spend almost the entire time in the bathtub just floating and sleeping in there. Like my wife had to check on me, make sure I hadn't drowned. I mean, like fucking, it was really painful, and most painful virus I'd ever been through. Much worse than any flu, also, but it didn't have the flu effects. It just was so much more painful, much harder to take. Anyway, I was hell bent on natural immunity, and I got it. And so now I think I've had two further. I even tested one time when I think I got it again. It was like a year later, and I did. But it was like nothing that second time, but it definitely was. It was like nothing that second time, but it was definitely something I had, and I was wondering, and I did. I had the COVID-19, um, unless those tests are inaccurate. But then now, just like 3 weeks ago, I got something again, and I'm pretty sure it was that. I didn't even test it. You can just sort of tell it has that. It's a certain combination of just extremely annoying and not that bad. Because a normal cold is what is it? Annoying as fuck, right? It's like it takes you down. A normal cold takes you down. But when I got struck with the COVID-19 again, I think this third time recently, because I'm a naturally immune, it didn't hit me too hard, but it felt like a hollowed out cold. Like I didn't have sneezing and sniffles and and I didn't have um, you know, flu symptoms or anything like that. I didn't even really have much fever. I think one day I had like a very low level fever for like 4 hours, very low level. It was nothing to worry about. But then what happened was that cough and that lingering cough, and it's definitely that COVID-19 lingering cough. I think that the COVID-19 is majority, like 50 or 50, 60%, a respiratory virus, side effect illness. Um, but anyway, so I like Evan's streams. Hey, good morning. Shred Rickson, how are you? Makes me look at trading slightly differently than I usually do. I'm glad to have you, buddy. Um, what I can say this morning about the market, I will tell you in just a second, but I'm going to finish up this COVID-19 thing. So, anyway, yeah, I'm on the tail end of that. Just had some coffee. Caffeine's not the greatest for you to when you're fighting something off for your immune system, but I do what I do. I do what I do. All right. So yeah, did I already talk about it? No, we talked about jobless claims. So now PPI, that is the leading kind of inflation number. The producers price index, they used to call it the wholesale manufacturers index, which gives you an insight. When you think of it that way, it was like there was a retail and wholesale index. Now they call it CPI and PPI. When you think of it that way, it gives you an idea, a real common sense and logical idea about how PPI is really the leading number. What's going on in PPI hits us, well, does not hit the consumer, does not hit the economic society at whole and get washed in and baked into revenues and and money circling around and cycling around yet. It's the beginning of that. It's the pipeline costs essentially. Think of it that way. The wholesale costs or the cost to produce a TV to get into Best Buy, the cost to produce it, right, with all the materials and all the exchange between other businesses and everything it took. That'd be the producer's index. Then the cost to sell the TV and put it on the shelves, ship it, put it on the shelves, have it sit in inventory for 3 to 9 months, sell it, and then those costs, that's what we see as CPI. So CPI is a lagging number. Everything's lagging. The only thing that actually doesn't lag is the market itself. You can the market is the most amazing indicator there is. It's the most cutting edge, leading edge indicator there is, the market. So you got to learn how to trade and read price action on charts, by the way, with pivot points and levels and all that. But anyway, PPI leading index is one of the more leading index than CPI. CPI yesterday came in good, 3.3% and 3.4% core. But today PPI came in zero on core, zero. That's the first return to zero, and then negative 0.1% month over month on overall. So that is the most beautiful, amazing, good sign we've had regarding inflation, and it just seems like we're going vertical right now amidst numbers which are telling us that The business cycle is taking off. This is unbelievable shit. Like somebody made a post on Twitter last night or this morning, somewhere in the middle of the night. I read it saying, how does this, because they were wondering, how does this run up, just call it a run up. I don't know which one they were talking about. This one, the recent one for the last few months, or starting November last year, or in total since the bull market started. Um, how does it compare to the dot-com bubble of 2000? And I gotta tell you, like, anybody lived through the dot-com bubble? Does anybody remember the dot-com bubble? How the market was? I was on the market, trading the market during those times. Does anybody remember that? The dot-com bubble. If we could get the dot-com bubble out of this, it would be the most phenomenal sighting you've ever seen. This is nothing. In fact, this is like there's a lot of trepidation on the market. The dot-com bubble was was it was a bubble for a reason. It was the point that the if you put a .com on anything, or if you IPO'd anything, or if you were on the stock market at all and you .com'd whatever it was, if you just digitalized, you put yourself on the yellow pages back then is the way the internet was thought of. If you .com'd anything, you were guaranteed thousands of percent gain. It was absolutely insane. And I think it'll be unparalleled. And that's why it was a bubble. It's just everybody and their mother and their grandmother was throwing everything they had, and people got wiped out by the pop when the bubble popped. But the run up was this is nothing. Like we had what 65% gains last year on QQQ, I believe it was. Well, very beautiful year on QQQ, or it might have been the previous year. One of the last 2 years was a very strong year for growth stocks on the QQQ. Um, you'll be talking about 150%, 200%, triple. I mean, it's almost undiagrammable. Some stocks went up 10,000%. It was a bubble. You could taste it was a bubble. So here's the interesting thing. we're we're extended. We have a very nice, beautiful, strong bull market that's been going on, right, for the last year and a half. We have very healthy consolidations, everything within the realm of reason and logical. Okay, dot-com bubble was not logical. It was irrational exuberance, is what they called it. And these, pullbacks, that was during, that was some global geopolitical crisis warnings right here, and then we came right back out of that. And we've skyrocketed through that. We broke out, and we're way up here. Look at this move just in the last month or so. It's 15% move. Well, it's very extended. We're skip jumping. We've got gaps that are continuing green instead of Gap Island top reversals happening, which is should be typically what we see. But today we got this PPI report, which is saying, you know what, we're doing better than you thought. Like, holy shit! Like, but we thought we were doing good, obviously, because the market is showing that. Okay, although a lot of the market is moving on the biggest caps, frankly, like Apple and we looked at it the other day. Some of the biggest ones are Broadcom, um, Apple, and Costco, and one other one. One of the other tech companies, but it was surprising that Costco was in there. But yeah, Costco is just doing phenomenal and is just a monster behemoth, and elevating the Qs and SPY a little bit. It's like 5% weight on the market. It's pretty insane. Costco. So anyhow, we are so extended, and yet this PPI print is telling us for the first time, take the shackles off. Let's go. The economic business cycle is continues to look like it is taking off. And when it fully does, the Fed will be lowering rates. And it looks like that's going to be next year mostly, but that's fine. That still works. But can you imagine the PPI signaling? Let's take off. Let's go for the rest of this year for 6 more months or however many more months there are in this year, 7 months, and we you know digest and push and have healthy bullish activity for the rest of the year, and then we start getting rate cuts. What do rate cuts do to innovative companies, to leading edge companies, to startups, to even big companies, as far as the money they can get at lower rates? It's like fire on, it's like kindling on the fire. And we're just beginning. That's why I've been telling you for a while. It's like we're just barely beginning the business cycle. And once the business cycle begins, economically speaking, it lasts on average 2 to 7 years. Sometimes, in rare circumstances, it goes 11 years. Most of the time, it goes for about 6 years, 4 years, 5 years. You can rely on about 1.5 to 3 years, somewhere in there is a sweet spot of a reliability you can expect, the minimum, because it just takes that long to get things going with quarterly reports and maneuvering the economic system. I mean, the rate cuts are going to go on through 2026. So you have a long runway of starting up the engines on the economic cycle. Putting the brakes on the economic cycle is what we've had. And look at how the market has been front running. We talked about this before. The market has been front running us starting up the engines. Perhaps when we start to do rate cuts, we'll digest for a long time, like 6 months to a year. Perhaps next year, 2025, might be flat just because we front ran so much, but probably not, because what's going to happen then when rates start coming down is you're going to get more hiring, you're going to get more growth, you're going to get more productivity, more GDP, and that's going to cause more deflation. That's going to cause more consumer spending without inflation, and that's going to cause more prosperity, more revenues. PEs are going to go up. If PEs, well, go down rather. If PEs are looking like they're going to be causing growth, and the growth trajectories on these stocks can continue in the way that they would be in a business cycle, then the prices can't help but go up. As Bill O'Neill always said, prices are high for a reason, and you can't stop that. And also, he said, prices on stocks don't double on technical analysis alone. So stocks may digest on technical analysis. Between quarters, between quarterly reports and potentially flagpole updates, uh, there exists an oscillation range that movement is free to go in the unknown void. In other words, the company says, here you go. Here's everything for real. Here's everything for real. And they give you that once every 3 months. Then after that, everyone's running around like a chicken with their head cut off. But one thing's for sure is they can't go higher than such and such, and they can't go lower than such and such. And that creates a range because of what the company just said and the way the economy looks and all the reports are coming out, right? And if everything's in alignment, then you have this range, and that's the trading range. And it'll do what it's going to do, and so long as it's healthy, then it's okay. When it's unhealthy, you get these giant panic drops. But lately, you've even seen those scooped up with fast right side reclaims. But my main point is that it can get incredibly insane. Look at the dot-com bubble as a model and example. What we have going on now is nowhere near that. It's probably 1/5 of that, a 20% comparison. We're doing great. There's been plenty of bull markets like this, but this is a nice, healthy, smooth bull market. The kind of extended move that we're making right now is is amazing, but it's just getting started. And if 2025 digests, because when rates start coming down, or the entire market's like, yeah, that's what I thought. I was front running, like we talk about the goose that laid the golden egg. You never sell it for the price of the golden egg. You always sell it for lifetime value. And when you see the prospect of the golden goose living for 70 years or whatever it is, then the value of the golden goose goes way up, and you could never sell at current price, the price of a golden egg. You could only sell the golden goose for the price of the lifetime value, right? Which appears to be nice and healthy and strong and elevated lifetime value. So that's why the stock market front runs. Well, uh, if we digest even next year, we still got a lot of runway this year. Now, that said, we got 2 minutes here before the market opens. That said, we are for the second time gap opening right now on PPI numbers that are leading, looking good. But we could digest this. It's very possible. You should know that when we gap up like this after an extension, at the end of an extension, we gap up, it typically leads to an island reversal, gap island reversal. And that shows its face in the form of running green for the first couple minutes to 10, 20, 30 minutes, or even an hour or two, and then coming back down to the open. And the moment it turns red, it adds permanent pressure to that candlestick, to that moment. And then we tend to fill the gap red and then touch the close of the prior day. And when that happens, that's a full-on confirmed gap island reversal red. It's going to be a top for the next few days. You can at least say that much. So, you can hedge up whenever you start to see it go red. What could possibly happen, though, is we could be red right out of the gate. A lot of taking profits, a lot of wall of worry kind of taking profits. That could happen today, because this is the last of the trifecta over the last, yesterday and today, CPI, FOMC, and PPI. So now we're ready to digest, right? So there's lots of ways that the market can go today. And then finally, it could just be irrational exuberance. We could just have an incredible, let's tweak the trajectories on the leading companies and buy some more Apple. Let's go, and then the market just goes up green all day because all the accredited investors and institutional investors are starting to pour big money, smart money into the markets here, because they foresee, like I foresee, that this is just before the beginning. The gate hasn't even opened, and all the horses are ready to go. All right, we got 40 seconds till the market opens. So, like I said, anything can happen though today. So you got to take it day by day, and then have a look at the weekly charts. The weekly charts are also very extended. Um, uh, Weekly charts are a great way to. You know what I heard the other day was a really nice tip. Enter on the daily charts, exit on the weekly charts. Wow, that's really interesting. Although I kind of feel like the opposite should be the way it's done. Enter on the weekly charts so you get a nice, strong, true signal. And then, don't give yourself a 5-day, 7-day lagging exit. Once you're in a position and your risk is on, be careful. All right, market is open. What is it going to do? What are we going to do? I just got a fill on ANET. Do I have any more on that? I do. I have one more contract on ANET. Let's see. What did I get the fill at? 97 cents. Let's see if I'm getting a better price. I'm 50. What are we going on ANET here? I just got a fill on VRT as well. ANET's at 60% max profit. 78 cents, and I got filled right off the open at 97 cents. Okay, I'm going to let that gestate for a couple minutes here. Right off of the open, like I said, it looks like, well, I said everything though. I gave you every direction it could possibly go, but it looks like we're under a little pressure up here. That's what it looked like yesterday though, too. But I'm expecting a sell-off. Whether or not it's supportive, not a panic sell-off. But I expect there to be some digestion soon, if it's not today. Carl says, I helped bring a couple of those companies public. Man, that's awesome. Huge valuations and no basis. Yeah. Some fly by night good companies. Yeah. I remember it like it was yesterday. I was creating a startup. I had a startup. I own bombshelter.com. and that's worth a lot of money today. Because initially that was a media company I was creating in the year, I want to say 2000, 2001, so right in there. And we got all the the team to put together the numbers to see how much we want to invest in this thing. And when we ran the numbers, it came out um, that we wouldn't make money. That went against my intuition, and I was the CEO. I was the leader of this attempt to start up a company. It went against my intuition. However, I was younger. How old was I then? 25 years old or so, married, two kids, life pressures every day. Didn't have a lot of room to just think, and experience. Didn't have enough experience. Probably if we had moved forward, just the dot-com bubble boom would have uh, done what we needed it to do. Our excitement was about starting up a company was the same as everybody's excitement starting up their companies. We could have just got on the bandwagon. I didn't think like that. I was genuine. I've got integrity. I was trying to create a company that would work, right? I wasn't thinking, oh shit, man, we got to create some bullshit shell company and list it because this shit's going, to the moon. That's just not me. That's just not me. So I legitimately said, um, all right, well then, let's not start up the company. And if we were going to lose, oh, but by the way, I think it was very shortly after that that the bubble burst, and everybody was losing money left and right. And then we looked back and we said, the greatest decision I ever made was not to start up that company in some sense, because we would have lost millions. We would have lost millions. And so, in some sense, I tell the guys when I talk to them every now and then, my old friends, you remember when I saved us millions? Like, because we didn't spend the millions. Sometimes not spending money is saving losses. Not putting your capital out there when you shouldn't be can be a great decision, and can actually be you in this universe, not the alternate universe where you did it. It can be you in this universe saving all the millions or money that you would have lost in that alternate universe. No, I wasn't building bomb shelters, but here's the funny thing. Over the years, I've gotten offers from this brake company, some brake company called Bomb Shelter Brakes or something, brake pads. I think I got an offer for $20,000 at one point from them to buy out the name bombshelter.com. No, I still own it, and it's worth more than that now. And if there's ever a war or some shit, I'm sure it's going to go through the roof. But yeah, I own bombshelter.com for whatever that's worth, because that was the name of the. No, I wasn't building bomb shelters. No, no, no. It was a media company, is what I said. It was okay. So like, our idea was to put independent filmmakers' productions online. So my idea was what's now YouTube, right? But this was way before YouTube, like 7, 8 years before YouTube. But between YouTube and my idea, there was one competitor that was starting to make waves at the exact same time, named iFilm. Independent. They eventually became, I forget the name, but Sundance, with Robert Redford's company Sundance, and anyway, they were called iFilm, ifilm.com. Uh, they basically went forward with something similar to what I was going to do. But when you look back at it, it was the early stages of something like YouTube was what I wanted to do. I wanted to give everybody a free space to put their stuff. And that would have been called Bomb Shelter. It was a place for you to safely put your media without worry about critics. It was just like a critic-free place to share. but I didn't envision it like YouTube. My vision wasn't that good. And I have to, what do you call it? Be humble. I have to admit to myself. Uh, I didn't have I have good vision. I have vision, but the vision to see YouTube 7 years ahead, that's tough. And by the way, Netflix, they didn't even really have the vision. They were just acting on competitive premises. So when they switched over to digital, a lot of you might think that the reason why Netflix bankrupt Blockbuster was because Netflix went digital and offered online streaming digital rental, and Blockbuster refused to go online. A lot of you may think that that's what happened with the Netflix versus Blockbuster thing, and how Blockbuster was the word is stumbled anyway, and struggled to get gain space, market space in the digital transformation. That's not what happened. What happened was Blockbuster had a wildly popular um, subscription program. They were kind of like the first ones to do that with media. They created a weekly or monthly subscription. Does anybody remember? And you would pay this rate, and then you had either I think you could rent like 3 movies a week, or you had an allotment, and um, you had to you could hold your movie with no expiration. You didn't have to bring it back within 3 days, which was such a pain in the ass. And then they would penalize you. You remember that? Anybody? Blockbuster dudes? They would penalize you if you took it back late, and you have to pay this fucking extra fee. And you're like, all right, fine, whatever. And but they switched it out to a kind of subscription service. Well, Netflix competed with that, and it was DVDs in the mail, correct. Netflix was always competing with Blockbuster, but then when Netflix chose a similar subscription-based system, just the mobility of a DVD by mail service, almost like we use Zoom now, to fight the pandemic and stay at home. Um, the mobility that you got with a uh, DVD by mail system, now coupled with an exactly similar subscription service like Blockbuster had, that started to compete head to head. And you had this fluidity coming from the DVD by mail that seriously competed with the Blockbuster thing. And the pricing was better too. The pricing was better, and what you got and the convenience, everything about it just started to get better. And it was that killed about 80% of Blockbuster market share and gobbled up 80% of Blockbuster market share. And then there was the switch to streaming media. And then Blockbuster was slow to change and didn't change. They decided not to change. And that killed them. So, yes, you could say that, but the initial death actually did not come from the digital transformation of Netflix. It came from them just out competing on the subscription basis and the convenience of the DVD by mail concept. And then the switch to streaming was the final nail in the coffin. And a DVD, I think the last DVD on Netflix went out like a year or two ago. It was very recent that they kept the DVD by mail service going, but now it's completely all digital, which streaming, by the way, on demand, as we call it, we used to call it video on demand, VOD. Netflix is a VOD service. Well, guess what? Netflix isn't just a VOD service. It is what it is, and everything else is like a live streaming service where you don't get to choose, which is stupid, right? Like only grandmas and old generations are still using the telephones that connect to the land, that where you turn on the TV and you watch what you watch and you have nothing to say about it, whatever's on, like cable is what I'm trying to get to here. But that's interesting, right? That it's always this last generation that hangs on. And here's a very curious thing. The cycle of innovation, go look that up, this innovation cycle. Guess how long it lasts? It's very interesting. The innovation cycle lasts 80 years. And do you know what that is? That's the average lifetime of a human being. So in other words, the end of an innovative idea is when the early adopters grow old and die because they will not let go. That people won't change. They don't, whatever it is, like it's very hard uh, for you to be innovatively on top of and using anything that's the newest thing at all times through the rest of your life, because it would take too much relearning. You already became a master at the other thing, and it's just low. It's just no friction in just keeping it that way. So the interesting thing about the innovation cycle is that it's an 80-year cycle. Always starts with the first generation 20 years, and then and then it peaks around the 40th year. Between years 30 and 60, 50, you have like that hump, that peak, and then other things start overtaking. Unless that company can keep transforming, like something like Apple or one of those companies, an innovation company in and of itself, it can continue to create and ride the innovation curve. But interestingly enough, 80 years goes by, and grandma who uses the whatever phone they use has to die in order to stop using that service. They die off. Like there's no way, and that's what Elon Musk was talking about. He's mentioned it before. He says, you know, death is a good thing for innovation. That's what he meant. Because it's like we would we could actually progress faster if we had a shorter life cycle. If we would lived a shorter amount of time, we would pump through and cycle through innovative processes much faster, and we would move a lot faster. But instead, what's happening now is we're getting much stronger innovative advances just through a sort of Moore's law of innovation. We're getting stronger innovative advances now. It's like a parabolic return. And so our efficiency in producing GDP, productivity, as a single human being and then on a whole, is increasing as the new innovative um, assistive technologies come to the fore. Right? And so that's happening. That divide is getting so parabolic in difference that not only are we seeing the last generation, the last 20 years, 60 to 80, getting using the old technology and being obstinate about that and getting by with their older technology, but the divide is getting so strong now and causing inflation as well through high GDP and efficiencies. We're getting so efficient now, the younger 20-year generation, that they're able to so outperform all the rest that there's a divide, a chasm, a divide uh, between how efficient a youngin can adopt a new technology and create wealth and with it, compared to generations 20 through 40 and 40 through 60. That it's getting parabolic. And so it's sort of like adapt, evolve, or die is really happening. And it's probably getting to the point where maybe in 10 or 20 years where we'll see such a divide, such a technological speed of advancement, that the last generation, 60 to 80, will be so obstinate to change, which is just a natural human thing, that they're going to go bankrupt, like financially. Like they will lack resources to live. And they will just become, Bob left, they will just become unable to survive. We're kind of already seeing that, right? People are talking about, oh, cost of living is getting so high that, like, how am I supposed to have retirement? I can't even live in retirement off of what I save up. I'm going to be working till the day I die. Well, what I'm saying is in about 10 or 20 years, that technological difference in and how what you have to do to be prosperous and what you're doing that you used to do that you do and now you're retiring is going to get so wide that you won't be able to survive. Like you literally would die of famine, not able to buy food. I mean, you're not going to have the resources. So I suppose there's going to be like an elderly care welfare crisis that's getting parabolically worse moving into the future. But how can you combat that? Based on what I'm saying, is that you're going to have to keep dabbling and tinkering with the cutting edge. That's the only way you're going to stay viable. I mean, for example, just imagine 2 years from now when AI is trading the stock markets. I mean, they are already tinkering with it, right? Um, it's not good. I've been tinkering with it. They're already trying, and it's a lot of bullshit because AI is just sort of a language model right now. It's not really artificial intelligence, but when it does get there, they're using it as a stepping stone. But when it does get there, that'll be something. But for the meantime, it's not. But in a few years, if AI corners the market everywhere you can, want to drop liquidity, you're gonna have to figure out how to use that as a tool. And if you don't, you're gonna be a tool. No, that was great though. But and if you don't, then you'll be left in the dust quite quickly. So in one respect, as you get older, it's very easy when you're between 20 and 40. It's very natural and easy for you to adopt new processes and to dabble and put your finger and toes in the water of new technologies and keep yourself fresh. But I'll tell you, after about 35, 40, and then going from 40 to 60 range, it becomes work. It's different. You just that obstinance is a natural thing. You just would rather just stay with what works than learn some new system because learning a new technique system technology comes with its barrier to entry, which is it takes a lot of work to cut through, and only certain people will be able to do it. Be one of those. Be one of those, my friend. Be like water. So I was just watching right now the market while I was talking, just watching it. It's sort of holding the open. It's actually 4 point uptrending off of the open, but we do have a higher price pre-market. I have a feeling this 4 point uptrend is true, and we will break pre-market high at least. But what's going to happen by the end of the day? I don't know. I'm very curious. Be watching for it to come back to the open some point, midday, later in the day, to when it may paint a red candle way up high, just like we see here. If this candle turns red, it's very likely at that point to fill that gap, touch yesterday's high, which is confirmed number one, and then touch yesterday's close would be the strongest confirmation that there could be. But even a red with a topping wick, even a red that closes quite low in the candlestick body, but is still in the gap here. So it would be like a little red body with a topping tail because today we tried to push above pre-market highs and whatever it was, but then came back because it really couldn't be supported. Even that would be considered a gap island top reversal on an extension. It's so important to note that if that were to happen in a pullback, that's strength. But if that happens in an extension, it's exhaustion. And so keep an eye on that for the day. On like the S&P 500 is already that way, I believe. Let's see. Yeah, but it even opened in the wick. So an inside day is a nothing day. It means nothing. So on the S&P 500, although we're getting that pullback, it's a little bit doesn't mean anything. But what I am seeing that coming from here, you can see it right here. Here's the S&P 500 divided into growth, which you can see is elevated and rising slowly, just like QQQs. SPY-G, S&P 500 growth stocks are almost identically the same picks as the NASDAQ 100. It's very similar, and they act the same. but the money's going into growth. But then look at value. Yesterday, selling off, but then from the open today, down, 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 down. So that's rotation. That's rotation into growth. That's smart money taking money out of the ATM machine of value picks and putting it into growth stocks. It's an excellent sign for us on the growth market, and it continues to be just you know crazy. And but just remember, the market can stay irrational longer than you can stay solvent. So don't be trying to short an extension in an incredibly raging bull market. I mean, we've got a raging bull market. It's wonderful. It's nice and healthy, and let's keep it that way. Um, so we can keep it under control because there's nothing like just grabbing the tail of a tiger all the time. You don't want to get in because it's already extended, but then you should, crazily enough, because the next day it's gapping up and it keeps going. That'd be the .com, type of bubble action. Um, I don't really want that. I want a nice healthy market to continue. But when the next year, 2025, how the market responds to rate cuts, it's going to be very interesting. Uh, because you will not be able to deny raising valuations and growth trajectories. You won't be able to deny it. These stocks are going to be putting out 2 to 5 year forecasts at that point that things are looking rosy, and you're going to keep going up so long as the Fed keeps lowering rates. And so you're going to get those forecasts, and the valuations to sell the golden goose at the current price are going to go way up. And so no one's going to be willing to part with their shares except at higher prices. And so it's going to little by little as that vision opens up, the valuation, the current valuation, the future value, the current valuation will go up based on how that vision opens up, how the tunnel, how far you can see through the tunnel to the end. It'll extend if it goes very far and you can see the light and there's a lot of growth in there. It's going to affect current prices and current valuations because no one's going to sell you the goose that laid the golden egg for less than it can lay golden eggs for. Right. So anyway, keep on your toes though, because it's just completely normal to digest here. I think we should consolidate. I mean, we haven't had we haven't had a gap up green day breakout. Gap up that was green. We haven't had one in like a year and a half. So to do it back to back 2 days in a row, like today as well, it's 99. It's a 1 in 100, a very rare moment on the market. It's actually even rarer than that. It'd be like 1 in 1,000. So on extension. So stay on your toes, prepare for digestion, but don't be a short. Just take your capital out of risk when you need to, and then prepare to find a good entry over the next few weeks if we do digest, and find those entries and start planting your capital in pullback, and then let's let it continue. All right. Okay. So good morning, everybody. Have a good morning, and let's go back into the group. I'll see you over in the trading group. Have a good one, and let's keep each other abreast of different tickers. I will definitely check them out, and I'll let you know what I'm finding. And then finally, trade smarter, trade safer. All right, guys.